It's Sunday the 2nd of January 2022. I'd like to say Happy New Year to all the subscribers out there and any viewers through the YouTube channel. I'm going to do something a little bit different today, and that is talk about a few things I learned from 2021 investing in the gold space, in the miners. A few of these things I've talked about before, but I'm really just going to try and sort of cement them and go through a few charts. This video I'm putting out for free on YouTube. If you haven't subscribed to the Patreon channel, I do regular content. Most of my content now is through Patreon. $6 a month to subscribe. Usually have a couple of videos a week doing individual company analysis and also gold price and sort of macroeconomic stuff as well. But a focus on individual companies, producers and developers mainly, and a few exploration results as well. So if you're interested in that sort of more regular content, feel free to subscribe to the Patreon channel. I'll put a link in the YouTube description as well. So what I'm going to do is go through 5 things that I learned in 2021, and I think I've talked about a lot of these themes on the Patreon channel all year. The first one is ASX mid caps are not no-brainers to buy on weakness. I guess I spent a lot of time, probably between 2015 and 2018, trading these mid-cap, some of them are large cap now, but mid-cap gold miners, Northern Star, Evolution, Regis, St. Barbara, Saracen when it was before the merger with Northern Star. I traded these in and out of these companies a lot, bought weakness, 2 or 3 times a year. That'd be good buying opportunities, buy those opportunities, and try and sell the tops and consistently make these sort of really good returns. And that worked really well in 2016, 17, 18. If you could generally buy in that bottom quartile of the range for the year, and then sell it toward the top end of the range, and that's what I was doing. And I think probably I started to realize 2020 probably that there was some issues with these companies at a fundamental level, and I think that's really been borne out in 2021 in particular. All of these companies have struggled. They've underperformed the gold price, the GDX, they've underperformed that. You can see in 2016 to 2018, these companies massively outperformed the GDX in Australian dollar terms. So they were all up double digits, most of them up multiples, 20, 30, 50% there. These are calendar year figures, just raw returns, no this is excluding dividends, just share price appreciation. So these companies did very well. But that trade, I think, is over. And I think there's also, we've seen some bad moves this year by some of these companies. Particularly I've called out here, St. Barbara and Regis have done permanent damage to share structure via poorly timed acquisitions. And I guess the timing of those acquisitions has really come when they've had a poor operational performance, I guess, as well. I think that's a key point. They've really missed the mark doing that. And if we look at something like Regis, they did the acquisition of Tropicana, the 30% interest there, at around that sort of 280 mark, I think was the raising. And the share price has just been hammered since then. And they overpaid, but they've also had poor operational performance from their existing assets. And I think that the common theme between a lot of these companies now is old mines, really. They haven't really been building too many new operations. They haven't invested probably in growth in the last couple of years too much. Northern Star is probably an exception there. And I think they've done better in terms of their acquisition timing. The merger with Saracen was done at a point of strength from Northern Star's point of view. There was a little bit more logic to that as well in terms of combining the super pit and some of the other assets as well. So I think that's I still own Northern Star. That's the only one of these that I own. And I'm more bullish on that. And I think that's come down enough. But the others, I don't think are worth owning at this point when I've got a universe of decent mid caps on the Canadian market as well, who are also pretty well placed. And I think the other thing is all of these companies have got significant capex over the next 3 years, and the projects that they're spending that capex on are not they're not standouts. Particularly I think something like Evolution with the Cowal Underground. I think that's not a great project. Relatively high capex. The returns are not stellar. St. Barbara's got problems on all fronts. They've got Simberi in Papua New Guinea, the expansion there. Again, not a really high quality project. They've got this Gwalia sort of expansion opportunity now with the merger with Bardoc and sort of combining all these different ore sources, but it's not a standout, and it's not a company I want to own for a growth project. Whereas there are other companies with mid-cap companies with growth projects coming on that I think are better quality than those available here. So I think that's a first key takeaway. You look at all these charts, and as I said, they're all, I think Evolution probably held up a little bit better than some of those, but even 2020, these trends were starting to break, these long-term trends. I don't think we see a resumption of these trends anytime soon among these ASX gold miners. I didn't include, there are the sort of the next tier down, Silver Lake and Ramelius and these type of companies. I haven't included them here because they're not quite, they sort of had a period of rapid growth in this 2018, 2019 period where they weren't really mid caps at that point. But in any case, I think that's a key theme here, and I think you really got to pay attention to the quarterly performance of these companies, operational performance, because they're not as high quality in terms of their, particularly the capex, that capex spend. There's not going to be good returns for shareholders in the next few years here from dividends or growth projects. I think Northern Star's a bit better in that regard, just because I think the scale of their operations are a bit larger than what the others have. They've got those 300,000 ounce plus operations where there's a bit more opportunity to improve things as well. So that's my number one key takeaway, because I played this theme a lot, and it's now I've shifted. People watching the channel have probably seen me shift more toward the Canadian stocks, partly because of this, that there are opportunities in other markets that I think these companies and probably are not as well placed as they were, where they were the stars of the gold mining sector in that 2014 to 2019, say. Next key takeaway, production costs are rising across the industry. This is a chart I got from the World Gold Council website. This sort of shows the trend. You can see here all-in sustaining cost going from about 920, 930. This is only into the second quarter 2021. I think it's probably going to be pushing up toward that, close to the $1,100 US an ounce mark by the end of 2021 if I can get some later data. But I think this trend, the ASX miners, those companies I just talked about, I think they're even up. They're probably up more. I haven't run the numbers, but I would say those companies have had all-in sustaining costs rise more like 30%, 30 to 35% over the last 3 years, versus the industry average probably in that around that 20-25% mark. And this might be some of the bigger caps might be skewing this data a little bit, but I think it's the key point is there is that sort of inflation pressure now on the industry. And I think the other thing is that going back to these companies, these large cap, the mid cap ASX gold miners, their performance to me has not been driven by cost inflation as much as sort of geological deflation. The quality of what they're mining has really dwindled in the last few years, grade wise, for example. And I think that's the trend, sort of underlying trend why their costs have been increasing. It hasn't been driven by these sort of cost pressures on fuel and all these sort of things, and labor in the last couple of years with COVID restrictions. Whereas I think the industry probably has been affected more by those cost pressures in the last year. In particular, the Australian miners more on the side of geological cost pressures, I guess. So there's two different factors there that I like to think about. So ways of thinking about this as well. Look for companies with new ounces that offset these cost pressures. So, growth projects that are higher quality than their existing operations. They've got better grade, they've got better economics. If we look at something like Perseus, which one of the only sort of on the ASX was one of the few companies to move up in that sort of mid-cap space in the last year, that was driven by the Yaouré project in Ivory Coast. That's been able to keep a lid on their costs, because it's a much lower cost base than their existing operations. And I think the other thing is look for companies who can sustain medium-term production without need for major capex. I think that's the problem with some of those ASX miners. Whereas if I look at something like Endeavour, they can sustain their level, but they're probably looking to spend capex anyway. But I think they can keep their level pretty solid from a cost point of view, just because their mines are relatively new. versus some of these sort of legacy, sort of older operations for the ASX miners. SSR mining, for example, as well. Those operations have tended to be running at their best this year across the board. So they've been able to keep their costs relatively in check versus the industry, which is having these cost pressures. So I think that's a key thing. Look for sort of that growth that can come. Even if they've got some satellite deposits which have got better grade that can offset those sort of general cost inflation pressures. So that's something else I'm looking out for. Number 3 takeaway: developers have more risks than in recent years. I've talked about this Lassonde curve, or whatever you want to call it, many times, and sort of particularly riding companies from this orphan phase through to this, into commissioning and ramp up into production. That's traditionally been quite an easy trade in the last few years, but in an inflationary cost environment, that changes. And I think depending on what stage of that construction they're at, if they're able to get those costs sort of locked in a bit earlier, probably if they were in construction by mid 2021, maybe their costs have not been pushed up as much. But I think if you're coming into construction now at sort of the end of 2021, we're seeing multiple companies have problems with CapEx blowouts. And I think that term blowout is important, because it's not just when you start having labor issues and these sort of things, they're not just 5 to 10% increases in cost. You can get projects with 30% increases in cost. And I've mentioned that before when going through some feasibility studies, when they have the sensitivity analysis, and they'll have sort of a plus 10, minus 10 on the CapEx, for example. In this environment, they need to have a 30 on that as well, because you need to be able to see what that CapEx looks like, what the project economics look like at a blown out CapEx, because that's entirely possible in this sort of environment. So this is similar to, in Australia in that kind of 2011, 2012 period, where there was, these booms in the industry really push up labor costs and push up project costs as well, particularly for these sort of large projects, say, 500 million plus sort of projects. And the other way to play this, to sort of hedge this theme, is to have exposure to mine building companies. And the two that I own on the ASX, or these are processing plant builders really, GR Engineering and Lycopodium. GR Engineering I've talked about on the channel probably for the last at least 12 months, and it's been one of my best performers this year, non-stop performance, my average sort of in that 110, 120 sort of region, and it's just closed at a near all-time high for the year. They've done multiple upgrades this year of revenue guidance, and last year as well, still paying very good dividends too. Even Lycopodium has outperformed recently when they came out with their guidance. So my average on that one's sort of around that 430, 440, I think. So been happy with that as well. And I think they're more exposed to the African theme than GR, who are more Australian based. But this is a key theme, and it's something. These slides are really a reminder for myself as well, because I've played these developers a lot. I've got burned recently with Geopacific Resources on the ASX. Their costs increasing, and that's I don't know how that's going to turn out at the moment. They've gone in a trading halt, but that's just an example, and there's been other examples on the ASX and in Canada of these cost blowouts. So that's something else to look out for. Another one, companies without tangible projects came back down to earth. So in 2020, we saw a lot of hot money come into the sector. I was getting requests on the channel, every other week to look at some company that's had a really good performance recently, running up on some drill results or a new discovery or this sort of thing. Companies like Tesoro, Nova, Chesser, Musgrave, Los Cerros. These are a few that were listed. Generally, my attitude to these, I don't chase stocks unless I see something there that is of real quality, particularly sort of that early stages of drilling. I think Tesoro was an interesting one. I published a video at the start of 2021 talking about some companies that I avoided and why I'm still avoiding them. Tesoro and Nova were both on that list. And you look at Tesoro's performance in 2021, or from the highs of of last year, down from 50 to sub 10 cents. That's the sort of thing that can happen when you don't have a project of scale. I sort of look for critical mass. If it doesn't have critical mass, or I don't think it's going to have critical mass, I avoid it, because the only way you're going to make money is purely sort of riding that speculative wave. And when I've really come into the industry in terms of investing in that sort of 2012, 2013 period, it was really difficult to make money. So I tend to avoid things that don't have tangible project quality. Even if you look at Nova, they've done a consolidation recently, but they were peaking above sort of 20 cents in the old money. Hard to see it on the chart here, but they did a 10 for 1. So share price was peaking above 20 cents last year, and now at 11.5 in the equivalent terms. So it's been a difficult year for these companies, and the speculative juices are just not really flowing. And when they don't, and then the money comes out of the sector, these companies without real tangible projects. Nova's got resources. I've got real suspicions about the quality of what they've got there in terms of a project, but it's just an example of another company that can struggle in an industry in a cycle where it's we're in that down part of the cycle. Chesser was another one. They had some good drill results last year. Share price peaked above sort of 30 cents right as the sector was booming in that about August 2020, and now down to sort of 12.5. So picking stocks that have something of substance will generally enable them to be not come under as much pressure as in the down cycle. Some value buyers will come in and pick up some stock, but these companies don't have that project scale for mine, or have sort of quality issues on their projects. So I think that's another thing to keep in mind, that these things go out in a good market. It's they look really good, but then when the tide goes out, they're really going to struggle. So that's I've always known that, and that's something I've really tried to talk about a lot on the channel, because the number one thing I try to do is avoid losing money in these sort of stocks. So I don't chase. So I'm always looking for something else. If I've missed something, especially something like these, which I don't think actually have real quality projects. So that's another takeaway. The last one here, and this has been talked about quite a bit recently, ESG is becoming increasingly more important. And I guess this is probably something I had overlooked previously, and I think it's something that's going to become more and more a theme. It seems like all the companies are pushing this a lot, and it's probably starting at the highest level companies, the large caps, really pushing for this, and that attitude is then trickling down to the rest of the industry, mid caps, and I think it's difficult for a lot of companies in Australia to really push this too much. If you're in Western Australia, you're in the middle of nowhere. You don't have many options on power, for example. There's really gas, or there's diesel, or this sort of thing, if you can get gas. And maybe some solar as well. There's no hydropower. There's no nuclear power as well with low carbon emissions. So it's difficult for you to really change your power structure too much. We've seen a lot of takeovers in Canada in the last probably 3 to 6 months, and I think this has really been driven by these issues, and probably because of valuation as well. I think that the valuation of some of the Canadian miners versus the Australian miners is probably better valuations, particularly if you look at the quality of assets available in Western Australia. I think is lower than what could be available in other jurisdictions. We've seen that that the Australian miners are moving into Canada, so obviously they think the same thing, that there's not assets there that they're really interested in. They're moving to look at other jurisdictions, and I think that's being driven partly by this ESG as well. So there's not a lot you can do about this really, and I think it's not a primary issue for me, but I think if you're talking about takeovers, for example, how you could really get that extra, bidding war for an asset, if it's a couple of companies are going after it because it has these sort of ESG credentials. It's got good grid power, it's in the right place, and then it's the right sort of scale for a couple of different producers to go after it. That's how you can get those outsized returns on a takeover. So we saw that last year we had the bidding war for Cardinal Resources, for example, with sort of a 3-way bidding. And that's, and we've seen this year something like even BHP and Wyloo going after to Noront Resources in Canada as well. That's another one where you get these sort of big boys going after something because it sits in their wheelhouse and maybe it has those ESG credentials as well. So something to look for there. A lot of assets as well, higher grade assets, underground assets are going to have lower carbon emissions per ounce just because of the geology. They don't have to move as much rock, don't have to crush as much rock, all this sort of thing to get an ounce of gold out. So, or alternatively, you could have something with lower stripping, less fuel usage, softer ore, less crushing, that sort of thing. So these are factors to look at. As I said, they're not the primary concern for me, but I think they seem to be becoming more important. And that's really at a company level as well. The companies are thinking it's important. So investors need to really think about this as well in choosing their investments. So that one there is not, it's still not a primary focus for me, but I think it's something to look for. So that's a few themes of 2021, and as I said, I'm trying to talk about these ones to kind of reinforce some ideas to myself for 2022. I think 2021 was a difficult period for gold investors. My portfolio was saved by a few really good winners. Like West African Resources, obviously, is probably the most talked about stock on the channel. That and PDI as well, really delivering those sort of outsized returns. But generally, I've also been saved by I don't chase. I try not to chase, and I try to try to cut my losers relatively short as well when things don't start turning around. So my portfolio probably up in that sort of 15 to 20% range for 2021 versus the those indices that are the GDX down in Australian dollar terms 9%. So it is possible to make money even in a sort of a weak environment, but you really got to be nimble. And I'm hoping that we can get an easier environment for gold investors in 2022, where the sort of that generalist money sort of pushes the sector up a bit better than 2021, where it was more of a stock pickers market, which probably suits me relatively well. But I'd rather a bit more of a tailwind for 2022. So hopefully you got something out of that, and hopefully hope to see you in future videos in 2022. Thanks very much.